What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update video is, as always, we're going to be taking a look at that Ortex short interest and utilization data. There is something very strange going on with it today that doesn't necessarily line up with what we're seeing on the price action. So I want to go over my thoughts on that. We're going to do some options chain analysis. And the most important thing that we really need to talk about is that market makers and Citadel in particular have some very substantial problems coming down the pipeline. Now, they may have gotten the best of us today in terms of all of the supply flooding the market, sending AMC down about 11.4% at the current time that I am recording. But the thesis that we have in terms of the short squeeze and the fundamentals behind AMC going forward have not changed. So I really want everybody to kind of take a deep breath, take a step back, and think about what we really know happens on AMC's earnings. The best thing is, shout out to TMI, we do need to keep staying cool, calm, and collected. So make sure you drop some of those down in the comments. Cool, calm, and collected. Now, when we think about what happens on AMC earnings, this is something that we have seen many, many times in the past. Now, when we look at AMC's previous earnings for Q2, we saw the earnings day right here, a little bit of a run up into the earnings day. We saw a little bit of a gap up the next day, but we finished pretty significantly red on that day before we ended up making that move to the upside. Now, I think something very similar could happen with AMC after this quarter's report. We do need to allow some time for the market to digest what is going on and what has been released by AMC and their management team. And the other thing that you have to consider is that there is a new wave of uncertainty entering into the market. The overall market is having a bit of a red day at this current time, and that is mainly due to the potential of Jerome Powell not getting nominated again as the Fed chair. So really, this drop, it doesn't feel good. I understand exactly where everybody is coming from. But what you also have to think about is that if the price rocketed up to $60 a share today, would that have really changed anything in terms of your plan going forward? I know for me, it would not have changed my plan and my exit strategy for when I potentially see myself exiting from this trade. Going up to 60 or any other of these higher prices that would not signify that we are in the squeeze really would not change anything in my mind. So let's get into some of this really important information. And before that, if you guys enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. Now, when we come over to this Ortex update right here, the utilization is sitting at about 85.77%. But the short interest today, according to Ortex's estimates, is down 3.96%. The estimated short interest as a percentage of the free flow is 15.9%. That doesn't necessarily add up with the fact that we are seeing a significant amount of selling pressure today. Now, we did just break above 40, which is going to be a very solid psychological level. And it is always possible for these estimates to get updated tomorrow once Ortex receives some more data. But at the same time, this does not really line up with what I would expect to see when we are seeing this type of price action going to the downside. Now, when we think about what's going on with the option chain, and you think about a gamma squeeze, which we're going to get into a little bit later in terms of one of the major problems that these market makers and option sellers have coming up, the gamma squeeze can go to the upside and it can go to the downside, because when you sell puts, in order to delta hedge those puts, if a bunch of them are running in the money, you go out and you short direct shares in order to maintain that directionally neutral status. But because of the fact that we had run up so significantly over the last week and on Monday's trading day, the puts and calls that are in the money right now are pretty even, and going into next week's monthly options expiration date, it's actually geared more towards the call side at the current time. Now, we also have a very interesting development today over in the European Union about payment for order flow. So when we come over to this article right here, the EU is set to ban payments for order flow. This is a very good development, and we know that the SEC is investigating and basically researching whether or not payment for order flow is a harmful practice in our United States market at the current time. I could tell them right now that it is, but they're going to have to come to that own conclusion themselves. So the European Commission is expected to ban the practice of payment for order flow in a new directive. The Markets in Financial Instruments Director, or MIFID, is expected to release a review that will include a ban on payments for order flow, according to a Bloomberg report. The European ban comes as the US SEC is evaluating what to do in the United States with payments for order flow. Gary Gensler has said in the past that this is on the table, and I do think that this would come in the future. We don't necessarily know how long this would take in order to come into effect, but when you think about the amount of order flow that is being routed to market makers, and there's really only two big ones, Virtue and Citadel, this is going to really place a lot of stress on their business model. Now, I know Ken Griffin did have that interview where he said that payment for order flow is a cost to him. At the same time, however, if he is paying for all of that order flow and is able to make a significant portion of revenue off of that investment into that order flow, it is going to hurt his business, because all of these exchanges have been creating incentives. I've shown you guys all of these filings in the past, in these rebates that these exchanges are putting out that these brokers will be receiving if they just directly route to the exchange. Now, if those incentives outweigh any type of payment that they would be receiving from a market maker or any other incentive that the market maker could provide these brokerage services, then the market makers really don't have as much of a place, and they won't have such a stronghold over our financial markets. Now, let's get into this second problem that Citadel has, and in my opinion, is the largest problem that we have seen them have over the last 10 months. And it comes down to back to this conversation with the option chain. Now, if you guys have been watching a couple of my videos over the last week, you know I've been focusing on this January 21st, 2022 options expiration date. Now, there's a couple of reasons for this. One is because the options premiums on AMC right now are much more inflated than they were before the June run-up. Now, this poses a massive issue for a lot of these market makers, because the market makers are the ones that are mostly selling these contracts to retail and other institutions in order to provide liquidity into the market. Now, when we come over to AMC's options chain, this is where things start to get very interesting. We know that there are a decent amount of in-the-money contracts at the current time on this strike. Or on this expiration date, 126,000 contracts. The important thing about this is that we have seen the massive pileup in June happen and how that played out. We've seen a big pileup in September, and we did see a pretty significant price movement to the upside. So we've seen a trend in the past that when there are a lot of contracts in the money and when there is a lot of open interest on the option chain, we do see a price movement to the upside. But this should not really be happening right now. The reason for that is because when we see every single week, a lot of these contracts right here, 171,000 contracts out of the money, 192,000 contracts out of the money. And when we see all of these expire, that is essentially money going down the drain and right towards all of these market makers or other institutions that are selling these contracts. Now, when we take a look at where the in-the-money calls are concentrated, they're not at the money. We do see a decent amount at this $40 strike, but a lot of them are concentrated a lot deeper in the chain. We see the $22 strike, 10,000 contracts. That's about 1 million shares. Then we see at 20, 2.5 million shares. Then at 15, at 10, we see a lot of these deep in the money contracts. Now, if institutions are holding these, they could be the ones that are forcing the market makers to go out and buy shares on the open market. But that's not really the most important part of this. And this next thing we're going to talk about is something that I haven't really talked about in any of my live streams or my videos. So make sure you guys pay attention to this next part. So when we go down to the furthest out of the money contract and we compare these prices to the furthest out of the money contracts that we saw back in June, it is a massive difference. So these contracts right here, let's go on the conservative side and say there are $150 per contract. In June, the furthest contract that was out of the money was the $40 strike. Now, in terms of a percent gain to get up to that 145 versus where we were trading at before the June run-up, we are actually closer right now in terms of a percentage gain to running through the options chain up through 145 than we were back in May. Now, when we think about what was going on with the option chain and the potential losses that these market makers were taking on that June run-up, let's say that those contracts back in June, those $40 strikes, were about $10 a contract. If those go up 10,000%, they are now worth about $1,000 a contract. The interesting thing here is that since the implied volatility on AMC's options chain is relatively high, and we also see that the options premiums are a little bit more expensive, on the next run-up, we may not see as significant of a premium inflation as we did back in June. But if we saw even a quarter of the options inflation and the premium inflation going into this next potential run-up, where the option chain is setting up for a January potential big run-up, those contracts would then be worth about $4,000. So market makers are facing potentially 4 times more risk on the option chain right now than they were back in June. If I was them, I would be terrified of what I was seeing on the option chain at this time. Now, what would the market makers do in order to eliminate their risk? Well, there's a couple of things that they can do. The first one, and in my opinion, the dumbest option for them to do, is to just wait it out and hope that these contracts expire out of the money. Is it possible that they do? Yes. Is it probable? In my opinion, no. There are still a significant amount of contracts in the money, and there was a lot of time until expiration for these pileups to continue to rise. Now, the second thing that they can do is buy to close the contracts that they have sold. But what they do then is just book the loss on the contract, and they need the liquidity in order to basically buy back those contracts. So what would they do then? Well, in order to do that and eliminate some of their losses, they would increase the strikes going out even further if we were to see that massive price movement to the upside. So they would basically just be delaying their obligations by using those further out strikes to try to pay off their obligations in the short term. The third option, which I think is the most likely at the current time, is they're going to go out and actually delta hedge. And they're going to buy these shares and potentially add a lot of buying volume as we start getting closer to this date, because of the fact that if they are going to face this risk of potentially having at least 4 times more exposure to the upside on these sold options, they're going to need to hedge their position. That adds more buying volume, pushes the price up even higher, and is more beneficial to us. So that is going to really wrap up this update on AMC. I hope this served as a little bit of a silver lining to what we have going forward. We know what happens around the times that we see these pileups on the options chain, and typically we do see the price run-ups about a week or 2 weeks before the actual expiration date. Now, another thing that I would like to say, and I hope a lot of you have gotten to this point in the video to make sure that you understand this statement right here, we don't necessarily need the option chain in order to run up. But what we do need is kind of a culmination of catalysts all coming together in concert to really force these price movements back to the upside. And again, nothing I say in these videos is financial advice. This video was not meant to have you go out and just buy a lot of these options. It's entirely possible that some of these expire out of the money, but the potential on this options chain right now is very significant and super risky to all of the option sellers, especially the market makers who are selling the vast majority of these contracts. So that is it for this video. I've got another pretty interesting video coming out for you guys later tonight. I hope you guys are having a great day, and I'll see you guys in the next video.